For years, Austin looked like it couldn't lose. But now prices are falling, buyers have power, and it's a warning sign for everywhere else. Honestly, if you blinked, you might have missed it. Just a minute ago, tech money was pouring in, and if you didn't buy a house yesterday, it felt like you'd literally never catch up. But, well, the script just flipped entirely. What's happening in Austin right now isn't just some local real estate fluke. It's practically a real-time stress test for the entire housing market.
Think back to the pandemic. Remote workers absolutely flooded in. Demand went totally off the charts and prices just skyrocketed. Then, bam, interest rate shock. The whole affordability math changed overnight. Suddenly, we've got cooling prices and inventory stacking up near record highs. Blind bidding wars? Yeah, those are pretty much gone, replaced by, actual negotiations. But here's the kicker, and this is super important to understand right up front. This is not a 2008-style collapse. It's a massive, functional recalibration.
To really grasp how intense this reset is, you kind of have to look at the sheer scale of the buildup. 68.9%. That is the jaw-dropping, 10-year cumulative appreciation we saw in Austin's average home price leading right up to that crazy peak in May of 2022. It wasn't just normal organic growth. It was like a powder keg of historically low rates meeting a tidal wave of out-of-state tech workers who were using their remote jobs to bid prices up into the absolute stratosphere.
So what did developers do? They looked at that frenzy and figured, hey, this curve is just going to go up forever. Between 2020 and 2024, they filed over 206,000 residential permits. Over 200,000. They unleashed this historic wave of housing supply, totally expecting an endless line of desperate buyers. But they accidentally built a massive trap for themselves. Because right as all those new houses finally started hitting the market, the Federal Reserve started aggressively hiking interest rates. Demand just fell off a cliff at the exact second supply peaked.
Which brings us to this really intense, practically cutthroat battle happening on the ground right now. On one side, you have your everyday resale sellers. They're totally trapped by the lock-in effect, right? Clinging to their old 3% mortgages, but trying to sell their homes to buyers who are staring down 7% rates. And on the other side, massive volume builders. And these builders are showing up to a knife fight with a bazooka. They're throwing around up to $35,000 in flex cash, basically paying tens of thousands up front to permanently buy down a buyer's mortgage rate to 4.99%. For a buyer, the math is a no-brainer. You just get a vastly better monthly payment on a brand new build.
So if you're an everyday seller right now, reality is biting hard. If you banked on getting those 2022 peak prices, you're in for a very rude awakening. Over half, 50.1% to be exact, of all active listings have had to explicitly slash their prices. The median seller is taking a $30,000 haircut just to get somebody, anybody, to walk through the front door. And even with that massive discount, houses are sitting there for over 90 days. Regular homeowners simply can't compete with the financial firepower of those massive builders.
Now, you might be sitting there thinking, okay, the whole Texas market must be imploding, right? Actually, no. Just down the highway in Houston, which has a much more deeply diversified economy, home prices are literally still rising, up 3.2% year over year. Meanwhile, Austin is down 3.6%, so this isn't some widespread statewide collapse. Austin's pain is a highly concentrated, hyper-localized hangover.
And the wild thing is, even inside the Austin area itself, the pain is incredibly uneven. The high-income central core, Travis County, is holding relatively steady with about 4.5 months of inventory. But the second you drive out to those suburban rings where builders dropped all those new homes, it's a totally different story. Williamson County is sitting at 5.2 months of supply. And if you go out to Bastrop County, they are practically drowning in over 7 months of inventory. They built a sprawling future out there that just never really arrived.
So when you have all this inventory piling up, prices falling, and builders aggressively undercutting regular folks, who's actually feeling the worst of this squeeze? Honestly, you'd naturally guess it's the entry-level starter homes or maybe the massive ultra-luxury mansions feeling the pinch.
But nope, it's not. The heaviest pressure is landing squarely in the middle. The $500,000 to $1 million segment is effectively frozen solid. This is the primary move up tier for Austin's massive tech workforce. But look at the tech industry right now. We're seeing heavy consolidation, major players announcing layoffs, and restricted stock units bouncing all over the place. Suddenly, the exact same tech workers who supercharged the boom are feeling completely vulnerable. They've tapped the brakes, and homes in this exact middle tier are just stacking up.
But here is a truly jarring contradiction for you. While the middle market is sweating, the top of the market is completely insulated. Get this, 38% of all luxury transactions over $1 million in Austin right now are being bought entirely in cash. I mean, think about that. The wealthiest buyers, senior executives, founders, cash-rich investors, they are totally insulated from the interest rate shocks freezing everyone else. They don't care what mortgage rates are doing because they aren't financing anyway. Because of that, the premium central neighborhoods have a rock-solid pricing floor.
This whole divergence raises a super interesting question. When the housing math fundamentally breaks, what's a market supposed to do? Look at California for a second. It's the perfect foil. The market there is structurally frozen. Prices are artificially propped up because everyone's clinging to their cheap old mortgages for dear life. Nobody sells, and almost nobody can afford to buy. But Austin took the exact opposite road. They actually let nominal prices drop to keep the market moving. And allowing those prices to fall acted as this massive, much-needed release valve. Because sellers accepted the lower prices and the inventory was actually available, existing home sales in Austin surged by 20% year over year. That literally leads all major metro areas in the entire United States. Austin essentially swallowed the short-term bitter pill of a price cut in exchange for having a functional, liquid market where transactions actually happen. And that fluidity translates into real-life human impact. Buyers actually have leverage again. Imagine a family that spent years getting utterly crushed in blind bidding wars. Now they can confidently walk into an open house and ask for concessions, demand closing costs, and negotiate repairs. Austin doesn't look like a housing market collapsing, it looks like a market desperately trying to remember what normal feels like.
But of course, just because the market is functioning today doesn't guarantee a smooth ride tomorrow. There is a heavy cloud of uncertainty hanging over all this forward-looking data. Right now, economists are fiercely debating two completely different timelines for when Austin will actually claw back its lost value.
To figure this out, analysts are essentially doing the math backwards. They're calculating exactly how many months it's going to take for today's lower prices to slowly compound and climb all the way back up to that historic $500,000 peak from May 2022. And the experts are deeply split into two very different camps. First, you have the optimistic scenario. Say, mortgage rates start to cool off a bit and tech hiring bounces back. Under those conditions, prices could reasonably grow at a healthy 5% a year. If that happens, Austin fully recaptures its peak value in about 3.5 years, landing us somewhere around late 2029.
But then there's the conservative timeline. And this points to a much slower, much more painful grind. If housing inventory stays bloated with all those new builds and interest rates remain stubbornly high, Austin could be fighting its way back for over 6 years. That means folks who bought at the absolute peak in 2022 might not even break even until the end of 2032.
So the data leaves us staring at two completely conflicting realities. Is Austin just taking its medicine right now to successfully fix a broken market? Or is this just the quiet beginning of a much longer, grinding correction that nobody fully sees yet? Jump down into the comments and let me know how you're reading these signals. Are we looking at a healthy recalibration or a massive red flag for the rest of the country?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.